Okay, day 5, section 3. We talked in the previous section about rational expectations, right? This idea that people use all available information and do not make predictable errors, and how this implies that markets then should incorporate all information within prices. And so, if markets have all information and they're already incorporated in prices, then this doesn't leave any room for individual investors to be smarter than the market or to beat the market, right? And so this has some pretty important implications when it comes to thinking about how stock markets work. If investors are rational, prices in stock markets reflect all available information, meaning there are no unexploited profit opportunities, right? You just can't beat the market. And so this leads to some important implications, right? And these implications are referred to as the efficient market hypothesis, right? The first implication is that no one can consistently beat the market unless they have better information, which is illegal. So basically, unless you're breaking the law, no one can consistently beat the market, right? That is one of the important implications of what we'll call the efficient market hypothesis. The second is that stock prices follow a random walk. What does a random walk mean? It means that future changes in stock prices are unpredictable. Because stock prices reflect all available information and prices only change when there's new information, future changes in prices will only change when new information comes about, but we don't know what that information is, so it's unpredictable, right? So in other words, you can't predict. Stock prices are as likely to go up as they are to go down in the future. You cannot predict what is going to happen to them, right? If you take these two things together, that you can't beat the market and that future changes in stock prices are random, it leads to a pretty clear conclusion that the best investment strategy is don't be a gambler, be a casino. And what do I mean by that? You should not be speculating and trying to play the odds and try to get big wins or big losses, and potentially expose yourself to big losses. What you should be doing is you should be playing for the long term, and you should be trying to win a little bit every time in a consistent, predictable manner. How do you do that? How do you do that in the stock market? Well, there's a couple of strategies that most investors should follow, right, according to the efficient market hypothesis. First, you should hold a broad and diversified portfolio of funds, such as an index mutual fund. Okay, we know the value of diversification, but here we're talking about a specific sort of diversification, a diversification that is as wide and as possible, but also one that doesn't try to pick and choose winners and losers, right? So basically what you want to do is you just want to hold the market, right? You don't want to be heavily invested in one aspect of the market or in one stock and less heavily invested in another. You just want to hold the market. That's what an indexed mutual fund is. An indexed mutual fund is basically a mutual fund that follows, for instance, the S&P 500, right? Or the Franklin 5000, right? It just follows it basically follows the market. And when the market goes up by 2%, your stocks go up by 2%. And when the market goes down by 1%, your stocks go down by 1%. But notice here, you're not trying to pick winners and losers because you can't. That's the implication of the efficient market hypothesis. So what you want to do is you don't want to try to pick winners and losers. You're trying to reduce what's known in finance as the idiosyncratic risk. Idiosyncratic means the risk that's associated with one particular stock, such as default risk, or the risk that the sector of the economy will go bad, or the risk from one manager making bad decisions. How do you reduce these idiosyncratic risks? You don't put too many eggs in one basket, right? And that's that quote I have here from Don Quixote. It's part of a wise man to keep himself today for tomorrow and not to venture all of his eggs in one basket. That's what diversification is, right? So don't put too much money in any one stock. Basically, try to follow the entire market, right? Now, diversification doesn't reduce all risk, right? You can have a diversified portfolio that looks like the S&P 500. If the S&P 500 goes down by 30% like it's done, you're going to lose, right? But you're not going to be experiencing excessive risk, more risk than that, right? You're not going to be also adding to that the risk that the particular stocks that you choose to invest more heavily in suffer more than the stocks that you did not choose to invest more heavily in, right? So indexed funds. One of the things about index funds is because they don't pick winners and losers, they tend to have low costs, right? So you don't you're not spending a lot of money on money managers that are buying and selling and doing a lot of research and trying to find, or try to find justifications for why one stock is better than another. You're just keeping your costs as low as possible, right? And so that's the other advantage of an index mutual fund, is that they're very cheap to run and they're very diversified. That's what you should be buying. And second, you should follow a buy now and hold strategy, right? In other words, you should not be trying to speculate. You should not be trying to buy high and sell low, right? Or I'm sorry, you should not be trying to buy low and sell high because what happens in general when you try to buy low and sell high, you end up doing what I said first. You end up buying high and selling low. And we'll talk about why that is. So you just want to follow a passive strategy, right? One that's not actively managed, but passive. One of the things we see about these index mutual funds is that they're very passive. They don't make a lot of trades, and that keeps their costs very, very low. Most index mutual funds incur costs of only about 0.1% a year, compared to actively managed funds that can spend 0.5% or up to 3%. So think about all those returns that you're wasting in management fees. Index mutual funds don't do that because they're not trying to beat the market. They're not trying to pick winners and losers. They're just trying to keep their costs low. Data suggests that on average, those who invest in actively managed funds do about 2% worse over the long term than those who have passive funds like an index mutual fund. So if you think about the power of compounding, over a 50-year investment period, lowering your compounded return by 2% because of these fees will leave you with 60% less money, right? 60% less money. That's how much these fees can really eat up your return. And so don't do it, right? Just buy some stocks that are diversified and hold them for a long period of time. The third part of the efficient market hypothesis is ignore professionals who claim they know what the next big thing is, because they don't, right? Will some investors or will some professionals beat the market? Yes, because of luck, because of dumb luck, right? We're going to talk here in a minute about survivorship bias. But survivorship bias reflects the fact that any period of time, some investment professionals will beat the market. They tend to be the one that survives. So what happens if you look today? How many investors have beaten the market? Well, quite a few, because they're the one that maybe by luck have survived. What's happened to the ones who didn't beat the market because of luck? They've gone out of business, right? So at any one point in time, most of the investment professionals in the market have beaten the market, but they've only beaten the market because of luck. It's similar to this Monday Night Football scam, which is an old scam that has been run, I think, many times, where you send a group of people an email that says, I know who's going to win the Monday Night Football game tonight. Half of those people you send team A, and half of those people you send team B. What's going to be right? What's going to happen? To half of the people, you're going to be right. So what do you do the second week? The next week you say, hey, I was right last week. Now I'm going to predict the game again tonight. To half of the people that you were right last time, you send team A, and to half the people you were right to last time, you send team B. What happens? Now, after 2 weeks, you've been correct with 1/4 of the people you began with, right? Now you do it 3 weeks, right? To half of the people that you were right 2 weeks with, you say team A. To the other half of the people you were right with 2 weeks, you say team B. What happens after 3 weeks? There's going to be what, 12.5% of that group you started out with that you've been right with 3 weeks in a row. And so the fourth week you say, what are the chances I would be right 3 weeks in a row? It can't be luck. I must be really good. So give me some money and I'm going to tell you who wins tonight. That's essentially what a lot of investment advisors are doing, right? That they survive because they've been lucky, and they somehow try to convince you that this luck is their skill. And it's not, right? It's just luck. And so, advisors try to tell you this, right? That they're better, that they're somehow smarter than the market. But I don't think that there's a lot of evidence for that, right? This is so hard for people to believe, though, right? Today, the newest data is that 50% of all assets are held in index mutual funds, which is way up relative to 20 years ago, right? Index mutual funds have gotten much, much more popular. But the question is, why isn't the other 50%, right? Why do so many people still waste so much money in fees by investing in active mutual funds? And, it's a hard idea for people to understand. People want to believe that there are smarter people out there, right? We want to believe that the world is somehow explainable. But take it from Warren Buffett, the person that many people point to as the guy who consistently beats the market. Warren Buffett says, when trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits, not the clients, right? Financial con artists assure everyone that they know more than you, but really it's a form of asymmetric information, right? They only know more about their complicated investment strategies. They often know that these investment strategies aren't very good, right? Well, they're good for them because it helps them charge fees. But the fact that you don't know this because you are not as well informed by them is a form of asymmetric information and moral hazard again. So recently, the U.S. Department of Labor now requires that all investment advisors behave according as essentially what are called fiduciaries. And a fiduciary means that you have to put the client's interests first and always act in the client's best interest. The fact that many investment advisors to this point have not been required to act as fiduciaries is really a pretty damning indictment of the whole industry, right? The fact that in the past, you could go to an investment advisor and he or she could be giving you advice that really serves their interest and not yours, and not be held liable for that it's amazing. It's amazing. So the fact that investment advisors are required to act as fiduciaries is a good thing. But one question that I think a lot of economists have is, if they're required to act as fiduciaries, they should be putting themselves out of business, because what all investment advisors should be simply saying is, put your money in an index mutual fund and don't mess with it. Of course, that would drive hundreds and thousands of investment advisors out of business. It doesn't appear like these investment advisors are going to be doing that, right? So there's this real question of, are they really acting as fiduciaries? Many investment advisors, if you try to talk with them about the efficient market hypothesis, will come up with lots of reasons of why it doesn't work. And in fact, we'll kind of talk about some of these reasons here in a minute. But I think the thing you always have to remind yourself is this quote by Upton Sinclair, that it's difficult to get a man to understand something when his salary depends upon his not understanding it. And I think that's true of many financial advisors, right? They, at some level, understand that the efficient market hypothesis works and that active investment strategies are not a good idea for the vast majority of investors. But yet they simply can't convince themselves of this, because to convince themselves of this is really convincing themselves that they're not doing a valuable work, or that they're conning people, which to some extent they are. Many people say, well, what about people like Warren Buffett? Aren't there some people out there that are smarter than the market? Well, I would say there's really two responses to this. First off, Warren Buffett's company has done worse than the S&P over the last 10 years. So there's a real question about whether Warren Buffett is just lucky, right? Somebody is going to, by random chance, beat the market many years in a row. And for a long time, that was Warren Buffett. Not so much the last 10 years, but for a while, he beat the market. But I would say the other thing about Warren Buffett is Warren Buffett actually has made a lot of his money because he has $1 billion sitting around in cash. I mean, one of the things that Warren Buffett has done very well is been able to buy low and sell high because he sits on a big stockpile of cash. And so during bad times like this, right, like during this pandemic, Warren Buffett's got a lot of money to come in and swoop up and buy things that are distressed, to buy up some real deals. And then he doesn't do that for 10 years or so, right? So in other words, he really kind of takes advantage of financial crises. Most people can't do that because most people don't have $1 billion sitting around waiting to spend at exactly the moment of crisis. And so, yeah, I think being an investor like Warren Buffett is great if you have $1 billion. But for me or you, we can't be Warren Buffett and we shouldn't try to be. What's the evidence in support of the efficient market hypothesis? Well, there's actually a great deal of evidence in support of the efficient market hypothesis. I'll just talk about it very briefly. First off, there's many studies that have shown that if you beat the market in the past, it is no predictor of you beating the market in the future, right? Even financial advertisements have to say this. If you have heard some financial advertisements on the radio or television, they always say past performance is no indicator of future results. And they do that for good reasons. That's what the data says as well. You can have somebody, an investment advisor who's been beating the market 10 years in a row. What's the chance that they'll beat the market next year? A coin flip, right? A coin flip. So this gets back to this question of survival bias, right? 80% of mutual funds go out of business. Why? Because 90% of active managers underperform the S&P 500 over a 15-year period. And so this creates a lot of churning, right? Funds go out of business and new funds come in, right? The ones that go out of business have underperformed simply because of luck, right? So this is kind of some amazing data. Only 281 mutual funds have survived since 1970 out of the thousands that have existed. Only 2 of those have outperformed the market by 2% or more over that time. This is roughly the same probability of flipping a coin and getting 8 heads in a row. If you flip a coin long enough, getting 8 heads in a row will happen. And that's the same with investment fund managers, right? It's reversion to the mean. I have a couple of handouts here that I wanted to show you in our list of handouts. Here's one question right out of today's headlines, right? Is Donald Trump a good businessman, right? Many people voted for Donald Trump because they assume that he's a good businessman. Well, what does that mean? Being a good businessman doesn't mean make money, because you can put your money in the stock market and make money. The question is, can you beat the stock market? In other words, is Donald Trump somehow smarter than the market? And this is actually some data that suggests that if you start back in 1985 and you look at where Donald Trump is relative to the S&P 500, he underperforms both the S&P 500 and the Manhattan Commercial Real Estate Index, right? Yeah, I mean, Donald Trump isn't beating the market. Part of the reason why Donald Trump is rich is he was given, what was it? I think $10 million by his dad. And so he's compounded that over time into some money, but not as much money as he had had as he just put that money in an index mutual fund. So in some sense, the data suggests that Donald Trump is a bad businessman, not a good businessman. Here's another article that you can read in detail later that says even experienced fund managers don't beat the market, right? And, once again, meaning that, if you actually look at most fund managers, they finish in the bottom 20%, right? Most fund managers are not beating the market. In fact, they're losing to the market by a pretty significant amount. Other data, very quickly here, about the efficient market hypothesis. There's a lot of data that suggests that only new information affects stock prices, not old information, right? And that only makes sense if you understand rational expectations. There's a lot of data that suggests that stock prices follow a random walk. In other words, changes in stock prices are not predictable, right? So it's impossible to predict whether stock prices go up or down over time. And there's a lot of evidence here that technical analysis, which is like searching for trends, looking for patterns or rules or breaking points, that none of this stuff works. It might work for a little while just because of random luck, but it doesn't work for a long time. Now, having said that, there are a couple of areas where the efficient market hypothesis does struggle to explain what's going on. And let me just talk about these really quickly. First is, there has always been what's called a small cap bias or small capitalization bias. That small firms seem to earn higher returns adjusted for risk than large firms. And economists in financial academics really struggled with trying to explain why this is, why exactly this is. It very well might have to do with worse information, that the public has worse information about small firms than than large firms. And that creates a bias in how investors buy stock. So, listen, if there is one area where it appears there does appear to be some potential for beating the market, buying small firms seems to be one of those areas. But of course, remember, small firms also tend to be riskier. But what the studies have found is that even adjusting for risk, smaller firms appear to be a better deal than larger firms. And so that's an interesting question that I think people are still trying to figure out why. There is some evidence that there's a lot of market overreaction sometimes to new information in the short run, right? So during 9/11, you remember the stock market crashed by 40%, right? And then when the market opened up again, it went down by 40% and then jumped right back up by 20%. You saw that this last month with the pandemic, right? Where the stock market fell by a lot and then it came back up. There does appear to be some evidence of overreaction, right? And so there appears to be a role of psychology in all this, that maybe rational expectations and the efficient market hypothesis doesn't completely capture. And I'm going to come back and talk about this here in the next section of our lecture. There's some evidence that there's excessive volatility. In other words, prices change by more than information changes. So sometimes it's hard to figure out why prices change because there's not even any change in information to drive prices, right? And so there is some evidence that there's a lot more volatility, particularly in the very short run, than there should be. And then there's, people always point to, how can markets be efficient if we have asset bubbles and crashes? And that's really what I want to come back and talk about here in the next section, is talk about a couple of new developments in the stock market, but then talk about how in the world do we explain asset bubbles and stock market crashes. So leave it right there. See you in a moment.